You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined today by my co-host John McEwen, and it's the 24th of August 2025. And in this week's episode, we'll be discussing London Stock Exchange Group, Ibstock, Deliveroo, British American Tobacco, Mondi. Our US company of the week is Eli Lilly. John, should I start us off with London Stock Exchange?
Yeah, how is LSE doing?
They're doing pretty well, actually. So they have come out with their half-year results, and revenue was up 7.8% to 4.5 billion. Performance reflected broad-based growth across all business units, and recurring revenue growth slowed to 5.8%, and that's expected to drop further in the coming quarter. Underlying operating profit was up 13.4% to 1.7 billion, and that was driven by top-line growth and improving margins. Free cash flow was up from 651 to 935 million, and the guidance was largely unchanged, with full-year revenue growth expected to be between 6.5% to 7.5%. A dividend of 47p was announced, and that was up 14.6%, alongside a £1 billion share buyback. The current market cap is just under 50 billion, so that would be about 2% of the market cap. In terms of where the revenue comes from London Stock Exchange, it comes from a few different sources. One of those is the analytics side of the business after they bought Refinitiv in 2021. And as a result of that, now most of its revenue is coming from providing tools and services that financial professionals use, basically, rather than just the stock exchange side. So if we break the results down a bit further by segment, for data and analytics, the growth was 5.1%. For FTSE Russell, revenue was up 5.1%, and that was 7.6% in constant currency. And risk intelligence, that was up 9.1%, and markets revenue was up 13.2%. In terms of how big each of those segments is, data and analytics was just under 2 billion, FTSE Russell was just under 500 million, risk intelligence was just under 300 million, and markets was 1.6 billion. So it's quite nicely diversified as well. In terms of the valuation, the business now trades at a forward PE ratio of 24.1. That compares to a 10-year average of 25.2, so pretty much in line. The prospective yield is 1.5%, and that compares to a 10-year average of 1.4%. I think this is a pretty decent set of results. Every segment's up. I think for the size of the business, the growth's pretty good. I think it's a pretty good set of results, actually, in fairness. I think my issue with it is just the valuation. It's a really, really high quality business. I think it's probably a business that in the time we've covered it has gotten better because it's become more diversified. But for a business that's growing revenue 7.8% a year, I think 24.1 forward PE is a bit pricey. I think probably a fairly similar business in terms of quality. It does remind me a bit of Rightmove, but I think with Rightmove, you tend to get closer towards kind of 10% revenue growth a year, whereas London Stock Exchange seems to struggle to hit that. So although I've got Rightmove at a similar valuation, obviously I don't mind paying up for a business of that quality, but I think I'd probably want to see another maybe 2 or 3% revenue growth for me to actually consider paying that price. What about you, John?
Yeah, no, similarly, I think it's definitely one for the watch list, and I've been more impressed with it the more times that we've covered it. I think appreciating that diversity and its competitive advantage in many ways. But yeah, valuation is the difficult bit. But on the watch list, and let's see.
Yeah, it's disappointing because it is a stock. Although it's a business that's kind of grown on me, I don't think there's a period we've ever covered it where it's been cheap. Yeah. It's not like some of them where it's like, oh, well, if we just realised when we first started covering it, it has always been very, very pricey. I hope at some point we'd get if the PE was 12, I think I'd buy it in a heartbeat.
Oh, yeah.
I don't think there'd be any issues there. But as we saw with Diageo last week, sometimes with these businesses, you do get the opportunity to get them at a lower valuation if you're patient. So London Stock Exchange is definitely one I would love to have, but at the right price.
Yeah. No, fine. What about Ibstock then? It is one I think you've owned in the past.
It is, yes, but no longer. So how are they doing?
So they're for anyone who doesn't know, UK's largest brick maker, and they had their first half results out last week, with first half revenue rising by 8.6% to £193 million. And this was driven by strong volume growth, which was partly offset by lower average selling prices due to an unfavourable shift in sales mix. Underlying cash profit, EBITDA, declined by 5.8% to £36 million. Bringing production capacity back online led to higher fixed costs, which the group found difficult to pass on to customers due to tough competition. Underlying free cash outflows improved from £15 to £10 million, and net debt rose by 4.8% to £145 million. Full-year guidance remains unchanged, with further volume growth expected in the second half, and underlying cash profits are expected to land between £77 and £82 million. An interim dividend of 1.5p per share has been announced, in line with the prior year, and the shares were up nearly 6% in early trading. In terms of valuation, Ibstock has a market cap of £562 million and trades at 15 times forward earnings, compared with a 10-year average of 13, and it has a prospective dividend yield of 3.4%. I thought these results overall were pretty good. I think it's encouraging to see volumes rise, and I suppose we've seen it to a degree with the house builders more recently. That demand is increasing, order books are growing. It is still very difficult, and there is a lot of inflationary costs. I know particularly 2-3 years ago, with the increase in energy costs, directly hit Ibstock, and that was a pretty big hit. A lot of that has been able to be passed on. However, UK energy costs are generally higher, and whilst with the brick makers, generally speaking, if you're looking at freight and importing bricks, it is expensive. There is quite a lot of domestic competition, so it's not as easy as you might expect to pass on the cost. And also, there is an international trade in bricks, and they come from much sort of lower economically developed countries that are able to produce them a lot more cheaply, albeit with that expensive import cost. My view with Ibstock overall, I think it's a fair company. I don't think you have quite the margins that you can get when the house building sector is booming, and that's probably the reason for me that I don't own Ibstock shares. Perhaps it's slightly more defensive and you don't see quite the volatility that you do with the house builders. And in terms of income, historically, it has had a slightly higher dividend and has been more of that kind of dividend defensive play on the housing sector. I don't think it's one for me, as I say, but I think you could probably do a lot worse. Sam, what are your thoughts on Ibstock?
Pretty similar. I think that was partly one of the reasons I sold it. I didn't see where the growth was coming from. And I think at that valuation, at that P of 15, you probably do want to see a bit of growth. I think you've got those long-term trends for the housing market that we talk about every time we cover a house builder. But in the time I owned it, and I think since I sold it, I think I must have sold it, I think going back at least 4 or 5 years now since I sold it. But in the time I owned it and since I sold, I don't feel like it ever really kind of cracked on and really delivered anything. It was just, I know maybe it was a bit naive when I bought it, but I didn't expect it to be so cyclical. And I know the fate will rise and fall with the housing market, but I just thought with its position as the number one and bricks not being lending themselves to being imported well or cheaply, it seemed like a business that could do quite well longer term, and it just never really cracked on. And I think in fairness to Ibstock, because it's not a terrible company, but I think you probably hit the nail on the head in that it's the energy costs. Because it shouldn't be cheaper to import bricks. It's just absolutely crazy. But I think that is just unfortunate for Ibstock in that although it's the number one in the UK has the highest energy costs in Europe, and that does mean that it's still struggling to compete with bricks that are able to be made cheaper elsewhere. But I just think as well, it's a very, very capital intensive business. And when you look at the returns it's delivered in terms of dividends, given it's not really growing, but if you look at it on an income perspective and compare it to some of the house builders, it's never really returned as much cash either. The house builders, you've always got much better yields out of them. So it's not really growing and it's not really delivering the income. So I do like it, and I think it is a good business, but I think it's a good business in what seems to be a tougher industry than it maybe should be. And I just think having followed it now for a while, I'd probably just buy a house builder instead.
Yeah, and I think it's interesting the point you make on energy policy, because say you had a more liberal policy towards fossil fuels, I think Ibstock could be a different company, but I think that is something that majorly hits it.
Yeah, it shouldn't be having to compete with imported bricks unless we have literally used all the bricks we've produced. Because a brick's heavy and it's cheap. It's not the kind of thing you want to be importing. But yeah, we are where we are with it.
Let's move on to a growthier company, Deliveroo.
Yes, Deliveroo. And I think it's actually, I'll get into it more, but I think it's going to be the last time we cover Deliveroo on the show. I don't know how much of a travesty it actually is, because we've never been overly positive about it. But Deliveroo have come out with their half-year results, and orders were up 8% to 147 million. Gross transaction value per order was up 2% to £25.8. And the total gross transaction value was up 9% to 3.8 billion. The revenue was up 9% as well, in line with the gross transaction value, to 1.046 billion. And the revenue take rate as a percentage of gross transaction value is 27.6. I don't know if I've just never noticed it before, but I'm surprised the take rate is actually that high. Very, very tough for the restaurants, I think, when they're giving away 27.6. But I suppose it's maybe a bit like eBay or like one of the auction ones where they stick it on the consumer and they also stick it on the restaurant's end. And that's how they're able to get it so high. But anyway, the gross profit was up 7% to 394.1 million. And as a percentage of gross transaction value, that was down 20 basis points to 10.4%. It's something we've commented on previously, but for what's meant to be a tech business, gross profit margin of 10% is incredibly low. And as the business is getting bigger, somehow it's getting lower. The adjusted EBITDA was up 46%, however, to 96.3 million. And as a percentage of the gross transaction value, that's up from 1.9 to 2.5%. So that's quite encouraging, at least. In terms of the loss, they had a loss of 19.2 million for the period. Free cash flow was up from 9.3 million to 46.3 million, and the net cash position was down 6% to 624.2 million. So plenty of cash on the balance sheet. Obviously, these results have come out. However, they are slightly irrelevant from our perspective because I don't think we actually covered this. The last time we covered Deliveroo was in March, so it was before this happened. But in May 2025, DoorDash announced that it was acquiring Deliveroo for approximately 2.9 billion. So Deliveroo shareholders were offered 180p a share, and that was a 44% premium over the share price prior to the announcement. And those two businesses are merging, and the new entity, once that finishes, will be listed in the US. It's possible we could cover it as a US company, but I'd be very surprised if we pick it because it's not really been what either of us have been overly positive about. Currently, that deal hasn't quite gone through, but the share price is at 178p. The offer was 180p. That tells you I think it's just a case of crossing the T's and dotting the I's. I think that's going to go through. The valuation is a bit irrelevant because it's not going to go above that offer price given the offer's been accepted, but it never had a PE ratio in the whole time we covered it, and it never had a dividend yield, so at least it's gone out in the same way it was since it listed. The DoorDash acquisition, I guess, makes quite a bit of sense, but they're doing that so they can compete with Just Eat Takeaway. Obviously, that's another one we used to cover before Just Eat merged with Takeaway.com, and that's now just listed in the Netherlands, and also Uber Eats. But, as we've seen when we've covered it over the years, it's just such a tough industry. I don't even know if there's a merged entity that's going to make it any better for them. But yeah, it's not one I'm overly disappointed to see go, although obviously we have had a bit of an exodus of some of the FTSE listed companies in the last year or two, but this is probably the one I'll miss the least, actually. But what about you, John?
Yeah, no, I mean, I'd always sort of considered it uninvestable, and it was targeting the least profitable part of takeaway food. So yeah. And I think it's interesting, you mentioned the take rate, 27%. Increasingly, like since Deliveroo kind of first came on the UK scene, and it was comparable prices within the restaurant to what you get on Deliveroo, and then you get this essentially sort of almost free delivery. Now, I think you see significantly higher prices on the Deliveroo restaurant menu compared with if you actually go in. So, yeah, that sort of, as a consumer puts me off it quite a lot. And as it happens now, I don't live in an area that's covered by Deliveroo, so I don't have the problem anyway. Yeah, I think if you're a shareholder before and you're up 40%, I would definitely take that. If you've been in it the whole hog since it listed, you probably haven't done very well. But I think considering everything, it's a fair price.
I think it's actually quite a generous price. I'm surprised they offered such a premium, but they obviously just wanted to get it done.
Yeah.
And there's maybe an argument that it's more valuable to them than it is to, say, private equity wanted to take it private, something like that. I think with DoorDash, at least it makes a lot more sense.
Yeah, no, absolutely.
Right, shall we move on to, I guess, maybe not a favourite, but a stalwart of the show?
Yeah, so, I mean, it's top 5 in terms of by market cap in the UK, British American Tobacco, UK's largest tobacco company. They had their half-year results out last week, with half-year revenue increasing by 1.8% at constant currency to £12.1 billion. Growth in the US, Americas and Europe more than offset weakness elsewhere. And growth from new categories slowed to 2.4%, with vapes declining 13% in the face of illegal competition. Underlying operating profit improved by 1.9% to £5.1 billion, not including around a £600 million charge for legal settlements in Canada. Free cash flow fell 42% to £1.2 billion due to the timing of US tax payments and payments for an ongoing court case with the UK tax authorities. Underlying net debt was down 10% to £29.7 billion. And the group's on track to meet full-year guidance, with revenue growth expected at the top end of the 1% to 2% range. And British American Tobacco intends to increase this year's dividend and complete the previously announced £1.1 billion share buyback. And the shares were up around 1% in early trading. In terms of valuation, the group has a market cap £94 billion and trades at 11.3 times forward earnings, compared with the 10-year average of 10.7, and it has a prospective dividend yield of 6.2%, compared with a 10-year average of 6.9%. I think for the group, it was obviously encouraging for them to see that things are still growing in the Americas and Europe. Main concern, looking at it from an outside perspective for British American, is that their new categories, so i.e. where the future of their business is supposed to be, had growth slowing to 2.4%, which is more like what you would expect from their traditional side of the business. And I think 13% declining in that main product that they do, which is vapes. Again, I thought they should be very worried about that, because again, that's where the trajectory of the business is going to go. It is now adding to the bottom line, but if that trend continues, that is not good. I think what you have seen with British American and also with Imperial Brands is, and it doesn't really reflect it in the 10-year average, because I think the 10-year average still contains that period 2016, 2017, where British American was rated at 17 times earnings. So you still got the end of that period coming to the average. But I'd have to recalculate it. But if we looked at probably more the last 5 years, I think then there's been significant re-rating in the share price. And that's what you've really seen in terms of the share price performance with both British American and Imperial Brands. So year to date, it's up 46%, and over the past year, 56% share price. Past 2 years, 70%. And yeah, the past 5 years, it's about 70% as well. So you've had significant periods of weakness. I think probably what you're seeing is that institutional investors have largely pulled out, and I think that had depressed the share price. And also, there had been that sort of theory where, how much of the world is still going to be consuming their traditional combustible products. And I think everybody's acknowledged that it has been in structural decline, and it is in structural decline. And there were periods, even since we've been doing the show for the last 5 years, where you've seen sort of mid to higher single digit drop in the volumes. And obviously, if that continued at that rate, then there isn't much of a business left if you're going a few years, and only so elastic in terms of how much prices can be increased. I think probably what's happened in the last year or two is you've seen the resilience of the earnings and possibly the volumes falling more slowly, and that being appreciated by the market, the amount of cash that it's generating, and the strategy which again I think has shifted in the last 5 years. Because 10 years ago it was much more of, can we acquire new vapes and new products? And in the case of Imperial Brands, they paid a huge amount for Blue, the e-cigarette brand from Reynolds. And now that has sort of slowed and the focus has been more on returning cash to shareholders, whether that be dividends or whether that be share buybacks, I wonder whether that's ignited things with investors more now, albeit not institutional investors. And that's why you're seeing more of a re-rating. There's possibly an appreciation for the resilience and, to a degree, the simplicity of the business, and perhaps the lack of uncertainty that you might get in other more growthy sectors. But that's just pure speculation on my part. Anything else to say? Yeah, I think the valuation, it's obviously not too commanding at 11.3 times forward earnings. I think it is a bit distorted in the 10-year average. As I said, I think if you looked at the 5-year average, it would be a fair bit higher. Dividend yield is still pretty decent. If you're looking outside your kind of REIT stocks, 6.2% is still on the higher side. And yeah, I don't think I have all that much more to say about it. Sam, what are your thoughts on British American Tobacco and these results?
I think the results, they're fine, but I think the new products, that's disappointing. I think that's really quite disappointing. 2.4% and the vapes declining. I think that's very, very disappointing. I actually sold my shares at the end of July. So I've actually just had a look and it's up 13% since I sold it. However, I only held my shares for about 13 months. And it's kind of like I just had some cash sort of sitting around, really. At the time, it was getting on for a 10% dividend yield. I hadn't expected it to go up anywhere near as much as it did in such a short space of time. And I think I'd have to work it out, but you're talking 50-60% in 13 months. Plus I got the dividends. It was a really silly return from a tobacco company. So although I've missed out on another 13% so far, I'm pretty comfortable. And I think as well, when I was buying it, it was like 6 times earnings or something like that, 10% yield. Whereas now it's only like a 6% yield. And I just think it's probably fairly valued in comparison to maybe some other FTSE stocks that are putting up similar figures. But if you look at it compared to where it's been in the last few years, it's really kind of gone up quite a bit. Now, it might be that the last few years it's just been abnormally low. But like you alluded to, I'd be far more comfortable holding one of the REITs and getting my 6% a year than tobacco, because there's a lot more unknowns. And if I think with the tobacco, there's a price at which I think I'd always be willing to go back in, but it would probably have to kind of go back down to where it was kind of like a 10% dividend yield. That's probably the level at which I'd consider going back in. But based on these results, I'm pretty happy with my decision to sell. And I did put the money into Novo Nordisk, which hopefully will come good at some point.
Yeah, no, fair enough. What about Mondi?
So, Mondi, I don't know if this is quite a debut for the show. It has been covered before, but not as a standalone company. It's only been covered in the context of it when it made that bid for DS Smith a year or so ago. So I don't think we've ever covered Mondi results to my memory. So for anyone who's not familiar, Mondi is a box maker and packaging company. They are listed on the FTSE 100, and it's a pretty similar business to DS Smith, which we used to cover fairly regularly before it got bought by International. I think it was I'll just check who it was. International Paper. Yeah, about a year ago.
Imaginative name.
Yeah, well, it does what it says on the tin. So now that we've lost DS Smith, which we did quite like, we're just going to start covering Mondi instead. But Mondi's pretty similar. It does paper, it does packaging, operates in more than 30 countries, and they have come out with their half-year results. And revenue was up 4.5% to 3.9 billion, and all these figures are in euros. Underlying EBITDA was down 0.2% to 564 million euros. The underlying EBITDA margin, that was down from 15.1% to 14.4%. The profit before tax was down 16.6% to 247 million, and the basic underlying earnings per share, that was down 15.5% to 42.7 cents. The dividend was flat at 23 cents. The cash generated from operations, that was up from 372 to 416 million, so that's an increase of about 12%. And the net debt to underlying EBITDA, that's gone up from 1.5x to 2.5x. However, they did make an acquisition, not DS Smith, as we covered at the time. They acquired the Western European packaging assets of Schumacher Packaging on the 31st of March. The acquisition of those assets included 7 corrugated converting plants, 2 solid board mills, 4 solid board converting plants in Germany, the UK, and the Netherlands, and it added over 1 billion square metres of packaging capacity to the network. It also expanded the portfolio with solid board solutions, especially targeting customers in e-commerce and FMCG sectors, which has enhanced their footprint in Western Europe. The acquired plants also include 2 state-of-the-art megabox plants in Germany. I think that's pretty sensible. Whether or not this was separate and would have happened anyway, but given that they weren't able to get DS Smith, I think this is quite a sensible acquisition. If we break the results down by segment, corrugated packaging. So Mondi is a leading producer of corrugated packaging with a cost-competitive asset base. They're the leading virgin containerboard producer in Europe and the largest containerboard producer in emerging Europe. So revenue was, for that segment, up 17.7% to just under 1.3 billion. Underlying EBITDA for the segment was up 42% to 203 million. And the EBITDA margin was up from 13 to 15.6%. The return on capital employed, that's at 7.8%. The next segment is flexible packaging. Around 50% of the revenue generated in flexible packaging is from industrial end-use applications, and the remaining 50% is consumer end-use applications. They're the global leader in craft paper and paper bag solutions. So for that segment, revenue was up 1% to 2.044 billion. Underlying EBITDA was up 9.4% to 302 million. EBITDA margin was up from 13.6 to 14.8%. And the return on capital employed for this segment is 11.5%. Uncoated fine paper segment, this is the last segment. So that produces a wide range of home, office, converting and professional printing papers at the mills in Central Europe and South Africa. And for that segment, revenue was down 7.5% to 619 million. This is what's caused, I think, the EBITDA drop, because the other 2 segments were pretty good. The underlying EBITDA for that segment is down 51.2% to 166 million. EBITDA margin is down from 24.8 to 13.1%. And the return on capital employed, that's only 3.6%. And that's actually down from 20.1% a year ago. So they've said, due to lower average uncoated fine paper and pulp selling prices, and also the prior year, it said included a forestry fair value gain that was higher. So I think the forests that they've got for the paper, that had gone up in value. And it'd gone up both years, but it'd gone up less this year than the year before. So that's gone through the P&L, it looks like. I mean, it's a commoditized business, isn't it? So if the selling prices have dropped, that is just the nature of the beast. In terms of the valuation for Mondi, they have a PE ratio of 16 and a dividend yield of 5.55%. I think these results are pretty good. The only thing that's you'd moan about is the uncoated fine paper division. However, that is just a change in prices, which they don't set. What they are selling is a pure commodity, and they kind of just have to take the price. So it's unfortunate, but I think it's a well-run business. It looks pretty diversified. I think DS Smith was always a business that I liked. I don't know why we never covered Mondi, because they are pretty similar. So we probably should have covered them both together, and it probably would have been more useful. But now DS Smith is gone, I feel like with Mondi, although I like it, I think at a PE of 16, given that it is going to be very cyclical, I think that's a bit pricey for me. I think the yield of 5.55% is very good, that being said. But especially if we compare it to DS Smith and some of the prices that used to trade at, because I do remember at some points that was a pretty cheap business at some points. I think for me, it's a business I like, but I just wouldn't consider it at 16 times earnings, even though the yield is very good. What about you, John?
I was going to say almost exactly the same thing. I think I'm in some ways anchored to where DS Smith used to trade at in terms of its valuation, and that influences me a lot. I think it's a well-run business, very similar to DS Smith in that sort of sense. One of the attractions is that I guess it's a semi sort of defensive play on a growth sector in the form of e-commerce and Amazon and the sort of packaging for that. So I do get the appeal of it. I think it's one that we'll continue to cover, but not there right now.
No, I've got a figure in my head for DS Smith. I think that used to, a lot of the time, seem to trade around 10 times earnings, and sometimes even cheaper, I think.
Yeah, and it's probably why it's been bought, because it was very cheap and it was listed in the UK, etc. So it makes a lot of sense for, what was it, Paper International?
Yeah, although I think the acquisition Mondi's done instead, it does seem sensible. But should we move on to a business that I think, given that we're both Novo Nordisk shareholders, I think I'd be very curious to see the results of.
Yeah, no, absolutely. So Eli Lilly is a debut on the show. We have referred to it in the past, but we've never actually covered it. It's the US pharma company and owner of Mounjaro, which is the competitor to Wegovy and Ozempic, GLP-1 inhibitor, but it's a huge company. It's got a strong insulin business, obviously the weight loss that we know about, as well as oncology, immunological division too. So it's a much bigger pharma company than Novo is, although Novo is, by European standards, the biggest and is still in its own right huge. In terms of the results, then, it was the second quarter, with second quarter sales up 38% to $15.6 billion against a $14.7 billion expected, driven by volume growth in its GLP-1s for diabetes and obesity, which more than offset a decrease in prices. Operating profit rose 85% to $6.9 billion against $6.2 billion expected, as sales growth outpaced the increase in research and development costs and other expenses. Full-year revenue guidance was increased by $1.5 billion to $60 to $62 billion, and the underlying earnings per share outlook has improved from between 20.78 to 22.28 to $21.75 to $23. Separately, Lilly announced a late-stage clinical trial data for its once-daily GLP-1 tablet, which is called orforglipron. The data wasn't as good as some analysts were hoping for, but the trial met all of its targets, and Lilly expects to submit applications for approval by the end of the year. And the shares were down nearly 7.5% in early trading. In terms of valuation, Eli Lilly has a market cap of $667 billion and trades at 28 times forward earnings, which is broadly in line with its 10-year average of 27.9, and it has a prospective dividend yield of 0.9%. I mean, I thought these results were stunning. They really absolutely going, and GLP-1s driving a lot of that. Mounjaro does seem to nail Ozempic and Wegovy when compared. I mean, they're all good, but it has that edge over it, and it's a bigger company as well. I think you are seeing a huge premium, and I guess historically you've seen a huge premium, whereas I think with Novo it's much lower valuation. I mean, when we were looking at it, it was under 15 times earnings, so this is pretty much double it. So is it worth it? I think time will tell. I'm very happy with Novo and how it's run, and it seems a bit more conservative, has an excellent diabetes business, and it feels like you've got the GLP-1s added to it, whereas a lot of Eli Lilly seems to be based on that it is going to dominate the market forevermore in that sector, which I think is far from certain. So for me, I would take the less risky approach as far as I see it, and I'm holding on to my Novo shares. But it is certainly an exciting business to cover, and probably got the most exciting growth story in the pharma sector at the moment. Sam, what are your thoughts on these results and Eli Lilly as a whole?
The results are fantastic. Obviously, the stock market didn't think so. The share's down 7.6%, but obviously the expectation must have been higher. But I mean, they've increased guidance, they've increased the earnings per share guidance, they've increased the revenue guidance. they've beat the expectations. So I find it really weird that the shares have reacted in the way they did. But it reminds me of Novo Nordisk a couple of years ago when we used to cover it before we bought it, and it was trading at sort of 30, 40 times earnings. And it was like, well, it was priced to perfection, and any kind of wobble and it will get punished a lot, which is what we've seen happen before we purchased the shares. And I think that Eli Lilly, I'm sure no reason to believe it's not an excellent company, but for a business of that size to pay a forward PE of 28, I just wouldn't be comfortable doing it, especially when you can get Novo Nordisk for, I think, less than half the price at present. I think with Eli Lilly as well, although they might have an edge currently, I think it's still quite early with a lot of this weight loss stuff. And as well, we're not even getting into the other applications, the other potential applications that these drugs could have for things besides weight loss, which we've talked about before. Given that it's all still so early in the market, I think there's going to be a lot more twists and turns. So to go and pay 28 times earnings, I'd just be uncomfortable. And I think as well, actually, it's probably going to be such a big market that they might both do really well.
Yeah.
I'd probably only consider Eli Lilly actually as part of a basket approach, but I just think when Novo Nordisk is at such a discount, it's been cheap enough to sort of make us break our rule of not investing in a pharmaceutical company. So whether that's something we look back on, that was obviously quite stupid. But I just think it reminds me of Novo Nordisk a couple of years ago, and it's a fantastic business, fantastic results, but the shares being down 7.6% following these results is a good example of why I wouldn't want to pay such a high price, because what more do you want from it if you're a shareholder? It's just, but great company, but I'm quite happy with Novo Nordisk for now.
Very good. Of the companies then, Sam, what's top for you and what's last?
So I think I'd probably put London Stock Exchange Group top this week. I think the results are pretty solid, growth in every segment. I don't love the valuation, but of the 6 businesses, it's probably the one I'd want to own actually the most at the current prices. Bottom is quite easy and quite fitting to rank it bottom one final time before it gets delisted. But Deliveroo, I think it is uninvestable. What about you?
Yeah, boring, but the same. London Stock Exchange, I think very high quality business. Yes, it's a bit pricey, but of these companies, that's the best one, in my opinion. And last as an easy, it's Deliveroo.
Right, I think that's everything in that case.
Thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.